Good morning, students. So today we'll be looking at a new topic known as cost volume profit analysis. In our last class, we look at process costing. We've looked at the meaning of process costing, the meaning of abnormal loss, described abnormal gain. Then we look at WIP and weighted average method. But today we'll be looking at a new topic which is known as what? Cost, volume, profit analysis. Cost, volume, profit analysis. What is the cost volume analysis, which is CVP? It is a managerial accounting technique used to determine how changes in sales volume, this volume is quantity or unit, variable cost, fixed cost, or selling price per unit affect a business operating income. This definition is very key. It's a technique used to determine how changes in the sales volumes or activity levels or variable costs, fixed cost, or selling price per unit affect a business operating income. It is also known as what? Break-even analysis. That is a point where sales equate costs. Do you get it now? Very simple. You need to understand this definition. Once you have understanding of this definition, in solving the calculation, it makes it more easier. Now, when you move to break-even analysis, it has certain assumptions and limitations. Let's quickly run through the assumption before getting to what the limitation. The assumptions are on the board. What is the first assumption? Number one, it says what? The selling price is known and constant. What this is trying to say, for you to solve any question on break-even analysis, you have to know the sales price. It can be in per unit, it can give it in value, so you must know that. And this assumption is saying if it is known, it must be what? Constant. Number two, the fixed cost is known and constant. That means you can't solve break-even analysis or CVP without what? The fixed cost. You must know what the fixed cost, and the assumption is saying even if you know it, it must be constant. Then number three is telling us here that the stock are valued using marginal costing techniques or contribution margin. That is what number three is trying to explain. So at the long run, we are going to know. Remember in our last, I will still teach you marginal and assumption costing. I will still going to run a video on it. So that means it's telling us here that it's only the product cost that will be valued. Then number four is also making us to understand that under CVP, costs are divided into fixed and variable. So that means you are going to have two costs. Is either you have what? The fixed cost or the variable cost. Then number next is telling us that constant sales mix. Here now is making us to know that when you have a multiple product, when you have a sales or a business has more than one product, so you can use what? The sales mix, but it's telling us here that it is constant. Then the next one is say what? Only volume affects sales. By the time we look at the limitation, we are going to see whether some of these assumptions are correct. So now let's look at the limitation. The first limitation is what? The selling price is known and is constant. Fine, that is the first assumption. But here, limitation is saying in reality, it is not always the case, because you can't expect me to have my sales for 10 naira for last year and still have it the same as this year. So in reality, it's not always the case. So the selling price is not always constant. It can fluctuate. Then number two is making us understand that the assumption that says costs are divided into fixed and variable costs, it is not always the case, because there can be semi-variable costs. That means a cost that has the element of fixed cost and variable cost, like the case of telephone expenses. So that means this assumption is not always true. Number 4, stock costs are divided into fixed and variable cost. But this one now is telling us that it's not always true. The cost can be divided into what? Semi-variable cost. In that case, you are going to use high and low to calculate your fixed cost and your variable cost separately. Then number next is telling us here now that stocks are valued at marginal. Then this assumption is not always correct, because it can also be valued using what? Absorption costing. That is, there are some questions you'll be given, they will use absorption costing to prepare it. So you are not the one that's able to factor them out. Pick out those costs that are relevant, pick out those costs that are variable costs, those costs that you need, then you separate the fixed cost element from it. So at this point, we are going to look at the method. How do you calculate cost, volume, or break-even analysis? There are 3 ways, there are 3 methods. You can either use the tabular, you can either use the equation method, or the graphical. Do you get it? So I'll be dwelling on this equation method, then in the long run I will look at the tabular method. Now, under the equation method, remember the first thing, once you can identify your selling price, if your selling price is known, then if your variable cost is also known, that means you can go ahead and solve your break-even analysis. So you must identify what is known as CM, which is known as contribution margin. What is contribution margin? Is selling price minus what? Variable cost. So ability to understand this will make you to solve your break-even point. So the first one, you have the break-even point in units. Break-even point in units is the fixed cost all over CM. That means how many units will be my break-even point. I want to know how many units, at what point will I make what? Will I break even? So if you can do this, you'll be able to know, to manage your costs, to know those things you need in your business. If you can prepare your break-even point, then you will be able to know that, okay, these things, these expenses, I need it. This one, I don't need it. This one must come first. This one is not necessary. So once you know how many units you need, or how many units that must be produced, or how many sales must be met, or how many sales you want to give us to project in the future, so you'll be able to work towards that. Then number 3, we talk about on now and again, which is what? Break-even point is sales. This is the fixed cost all over CMR. While our CMR equals to SP minus variable cost divided by selling price, or you can say CM divided by SP times 100. Do you get it? Any of the method will give you what? Your CMR. While you can look at it, your CM can either be what? Your fixed cost plus your profit. Do you get it now? So these are all the equations you need to solve your what? CM and break-even point in units. Remember that in our definition, break-even point is a point where our sales equate our what? Cost. The sales must equate what? The cost. At that point, no gain, no loss. So at this point, in our next video, we'll start with a simple calculation. So what I will advise you to do is to look at the formula. I'll be taking them step by steps. Remember the rules. The first thing, you must identify your selling price per unit. You must identify your variable cost per unit. Once that is done, you can get your contribution margin. Also note, fixed cost must be given in every question. So fixed cost must be what? Given. Then with that, you can proceed to your what break-even point in unit, which is what the fixed cost divided by what contribution margin. Then for break-even point in sales, you can use your formula also, fixed cost all over CMR. If you don't want to apply this formula, immediately you get your break-even point in unit, just multiply by the selling price to give you the break-even point in sales. So this topic, I will cover the single product and the multiple product, whereby you have a company that produces different products. So that means there will be what different selling price, different variable costs, and different fixed costs. So when we get to that stage, I will do more explanation on that. But for now, I'll be starting with a single product. So please, you can download this video, watch it all over till you understand the techniques and the formulas behind it. So by the time in my next video, I will pick a question, I will start solving calculations step by step. So at that point, once you are familiar with the formula, with the equation, then everything becomes easy. So please, for those that have not subscribed, you can click on the subscribe link. Once I upload a new video, you'll be able to get a notification. Then secondly, again, the comment box is there. You can comment if there's any issues. I will definitely go to respond to them. So thank you very much and have a nice day.